Hello, I'm Pradumna, and today I'm going to discuss the critical role of financial regulation in ensuring the stability and integrity of global markets. In this presentation, is financial system evolve? Regulators face the challenge of balancing innovation and economic growth with the need to maintain accountability and compliance. So, this presentation will explore the origins of regulatory power, the economic theories behind regulations, lessons learned from past financial failures, and the future of financial oversight. As we all know, financial regulation is a set of rules, laws, and guidelines designed to monitor and manage financial institutions. These regulations ensure that financial systems are efficient, transparent, and fair. Without proper regulation, market could become unstable, resulting in systematic crises that affect entire economy. However, overregulation can stifle growth, so finding the right balance is crucial. Today, we'll dive into the key factors influencing decision making in a regulation, the economic theories that shapes these policies, and real world case studies that show the effectiveness of financial oversight. Just as traffic rules prevent accidents and chaos, financial regulation prevent reckless behavior in market. Without rules, both diverse and financial institutions would take excessive risks, leading to crises and financial collapses. Regulatory power primarily comes from governments, central banks, and international organizations such as International Monetary Fund and the Bank of International Settlements. These bodies create policies that govern banking system, investment frameworks, and overall financial stability. Regulatory decisions are often reactive, tightening in response to crisis, but they must also be proactive, aiming to prevent future risks. Political influences, global economic conditions, and the need for international cooperation all play significant roles in shaping financial regulations. Decision making, therefore, is a complex and dynamic process. Several key economic theories help shape financial regulation. For example, the prisoner's dilemma illustrates how financial market participants may act in their self interest, leading to market instability if there is no oversight. The Pareto and Coase analysis suggests that regulations should be designed to maximize benefit without causing excessive market distortion. The regulatory sensation pyramid further explains how enforcement mechanisms range from mild penalties to strict interventions based on the severity of violations. These theories help regulators develop smarter, more effective regulations that can mitigate risk while promoting market efficiency. The approach to financial regulation is deeply influenced by political ideology. For example, free market advocates argued for minimal government intervention, believing that markets should regulate themselves. However, history has shown that unregulated markets can lead to disaster, as we saw in 2008 monetary crisis. On the other hand, anti-capitalists advocate for strong oversight to prevent fraud and market instability, but they can limit market innovation. Different regions, such as the United States and the European Union, have adopted different regulatory models reflecting their unique political climates. Financial regulation often evolve in response to market failures. For instance, the 2008 global financial crisis exposed massive flaws in risk management and inadequate oversight, leading to reforms like the Dodd-Frank Act. Similarly, the Lever scandal highlighted the consequences of manipulated interest rates, resulting in strict rules for transparency in financial markets. More recently, the collapse of the institutions like Silicon Valley Bank and Credit Suisse have raised concern about the effectiveness of current regulations. These cases remind us the crucial role of regulatory oversight in preventing unethical practices and ensuring financial stability. Economist Joseph argues that well designed financial regulation is necessary to correct market failures and prevent moral hazards, where institutions take excessive risk knowing they will be bailed out. As financial technology evolves, regulators are facing new challenges. The rise of cryptocurrencies, for example, has forced regulators to rethink traditional banking models and create rules and prevent fraud while promoting innovation. Additionally, the booming fintech industry has introduced faster and more accessible financial services, but these innovations pose risk if not carefully managed. Climate finance has also become a key area where clear regulations are needed to ensure accountability in funding sustainable projects. The question remains, should regulators impose strict rules to ensure stability, or should they allow more flexibility to foster growth? There are several frameworks in place to maintain financial stability. Basel III is one such a regulation that strengthens capital requirement for banks to reduce likelihood of financial collapses. The Dodd-Frank Act was introduced to increase oversight and transparency after the 2008 crisis. Additionally, the MIFID second and FSMA regulations help protect investors and ensure market fairness. While these frameworks have bolsters stability, they also come with challenges such as high compliance costs, difficulties with enforcement. The key to effective regulation is finding the right balance between the stability and the ability to foster innovation. The future of financial regulation is being shaped by several factors. The rise of artificial intelligence and digital currencies presents new challenges that will require innovative regulatory rules and modules. Financial markets are increasingly interconnected, which means that international coordination among regulators will be critical in maintaining global stability. Policymakers must find ways to regulate these evolving markets without hindering growth or technological advancements. Countries like the US, China, UK, and the European Union will be at the forefront of shaping global financial policies moving forward. In summary, the financial regulation is crucial to ensuring the integrity, stability, and growth of global markets. Lessons learned from the past financial crisis so that while regulation is necessary, excessive oversight can hinder innovation and growth. As the financial landscape evolves, regulator must remain adaptable and forward thinking. Policymakers should aim for smart regulation and promote stability without hindering innovation. For financial professionals and economists, understanding these dynamics is essential to navigate the ever-changing financial environment. References are provided here within. Thank you for your attention and happy to answer any questions you may have.